My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is George Goncalves. George, it's been a minute, man, and I am curious to hear about how you randomly met up with Alonso in Japan. But introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Like, thanks for having me on. And listen, great intro song. I mean, I thought you picked me for a different reason, which is, there's been reports of the bond market's death, been greatly exaggerated.
It totally works, man. You're exactly right.
Mark Twain sent out, cable back in the day saying that he was, his obituary was not true. And people are, been downplaying the bond market. Look how fast the bond market moves, right? So I think it's a great song for both directions. Yeah. So, great to be back. Thanks for the invite. For those that don't know me, I'm the head of macro strategy at a large Japanese bank called MUFG Securities on the broker-dealer side. Been in the bond market for 25 years, primarily focused on fixed income. Been, covering a whole range of topics over the course of those time periods. Been on the buy side for a little bit, mostly sell side strategist. Have a very traditional global macro strategy framework, but I have over the years evolved and really looked into incorporating the quant side and technicals. So really data driven, process driven analysis of fixed income. A lot of the things that you look at, Mike, as well, and focused on rates, mortgages, credit, U.S. money market, central bank activity, global rates, and through a pillar of four sort of processes: global macro, which is the fundamentals, analyzing the narratives, which in the world that we live in are so fast, and you have to really kind of disprove or go with the ones you really believe in. The quant technicals, looking at both scenario analysis, valuations, technical signals, and then on the other side, which people kind of sometimes tend to forget, this is still a people's business, and emotions get in there. And so understanding behavioral finance, I speak to some of the largest investors around the world. So I really have a really fortunate position to get a kind of be in the middle as an information broker to understand what the sentiment truly is out there. And then, in the US, we're also fortunate that there's so much great data. If you know how to mine it, there's a lot of great information on flows and what's going on at the exchanges. And so kind of throwing that all together is how I look at the world from a macro strategy focused on US fixed income.
Since you mentioned that point about the sentiment, the institutional clients that you're dealing with, and we're in different parts of the industry. I talk to financial advisors all day long. What is the mood among clients, institutional, more longer term allocators? Are they sanguine about risk assets? Do they believe, we're in a bullish environment for equity, still bearish on bonds? Walk us through that a bit.
Yeah, it depends on who you talk to. Look, I could tell you one thing, and I think the price speaks for itself. It's been a challenging environment in fixed income, very volatile. Things get difficult to trade at times. And it's potentially, most likely, unless you have a massive rally between now and year end, it's going to be the third year in a row of losses in fixed income space. And so you would expect that to temper enthusiasms, right? So, it's been a tough sledding. Another year it's been down. But I think, in general, there's, I think, at least counting down to a new year and thinking about asset allocation for next year, I think is where we are now, and trying to understand where you're going to pick your spots into the next year. But while that's happening, what I kind of call this kind of narrowing window of liquidity, from now through holidays, there's going to be less and less liquidity. And that's going to make potentially more violent swings in the market. And perhaps the last 2 days, or less really 24 hours, notwithstanding, the movements in the bond market really kind of emulate that.
So let's explain that. So why less liquidity, and how does that compare to other November, December, end of year periods for liquidity?
Well, because you're sitting on losses, most likely on positions over time, because the bond market does not completely just right itself. Not everyone's perfectly hedged. And on top of that, we have even larger deficits. And so we're still contending with the market structure has been evolving. And then there's who's going to really step up into a year where there's been losses. And so that could create opportunities, or the need to actually get rid of bad positions, whatever the case may be, that could amplify and swing markets at times. So I think just naturally, there is less balance sheet afforded to the system as we get closer to closing books at the end of the year. So I think that is a natural kind of seasonal pattern that happens. I think that just because we've had bigger losses back to back multiple years, that it could get more illiquid from here on out.
So I want to read this sort of opening few lines from your latest outlook and why I need the space and change it to the higher for longer paradox based on that. So you wrote, in our view, the Fed's higher for longer view is inconsistent with the soft landing as it ignores the long and variable lags of tightening, and it suggests higher restricted rates will not impact the economy why hike then? And of course, also assumes those slow walk cuts. Historically, they tend to cut rates pretty quickly. I am pretty amazed at how in the last 3 days, the narrative not only shifted, but also the confidence got extremely high that what the Fed basically has said is bullish and it means rate cuts are on the way. And that's why we're going to keep pushing to new highs, results in seasonality coming true. Let's talk through that. First, do you think that the market's reaction here is reasoned and logical, or perhaps incorrect in a knee jerk?
A little bit of both. I mean, I think it's in the right direction. I mean, let's be honest. Chair Powell could have been much more hawkish yesterday, and he took a more kind of down the middle, slightly dovish, which in the world we live in gets amplified. So they could have been more hawkish. And this idea now, we've been of the view that they're basically done. We've been of that view really since the middle of the summer when we started to observe what was happening in the bear steepening, and that the fact that long-term rates were going to tighten for the Fed. We were early on with that sort of view. It's largely kind of worked its way. It could continue to be a kind of thorn on the market side because it's not as if deficits are going to get any better in the short run. So I don't think we can really see a massive rally on duration yet. I think it's coming. But this idea that they were going to hike again, I mean, it was always going to be hard to signal or even just get to the point where they're clearly not just skipping. I mean, I'm really fanatic about you have to pick your words wisely. We're not on pause yet. They're still suggesting as if they're in a hiking cycle. So they're skipping every other meeting with the intent that they might hike one more time. And they really only have one more meeting, which is December. And so our view is that, of course, if they don't hike in December, people say, well, there's 2024. Why can't they hike next year? Like being on hold for 6 months, the next most likely move is lower, not higher, just from a probability of distribution outcome. So they're on hold again, just where they skipped again. They don't hike in December. I think that, the dots have to converge with where rates are. I doubt they're going to increase 2024's dots to suggest they're going to hike. So basically they're done. And so that's what the market's jumping on right now and getting super excited about. But you have to ask yourself, okay, if they're going to be done, how long can they stay on hold is the real next question. It's not about when the cuts start, because I think, Chair Powell, in general, the FOMC, they're going to stay on hold as long as they can until either something breaks in the economy or the markets or both. And we just don't know about that. So while we're waiting, it's building up all this pressure. I think it's not really conducive for risk assets. I think markets are reading that wrong. Duration's reading it right, but probably it's too soon.
Yeah, and that's one of the things that makes me skeptical in a bit of short-term dynamics, which I think are high risk still with this. But I keep going back to it's why is it that U.S. small caps have done so poorly? Well, the simplest answer is the right one. There are a lot of zombie companies that tend to be smaller cap, and if they're going to refinance into higher for longer, a lot of them with razor thin margins are not going to be able to survive. That creates at the margin, some increased unemployment, creates some potential default risk, and that's all consistent with what you see anyway with the recession. I guess the question becomes, would the Fed be willing to stomach and be late to lower rates? And I say that purposely because I think we can all agree they largely lower rates too late, but maybe have that be a bit more purposeful this time.
Yeah, I mean, I think the general thinking in different industries and different sectors, from commercial real estate to private equity to basically anything that's sensitive to interest rates, housing, you name it, there's always been this belief and that, well, at some point they're going to lower rates, so I'm going to be able to refinance, or I'm going to hold back on actually coming to market because I know I can get lower rates lower in the future. I think that, of course, I think Chair Powell and the Fed knows that as well. So if they really are trying to tighten and really continue the draining of liquidity and right size this kind of market, then they're going to have to wait. It's kind of like this game of a waiting game, a game of chicken, who's going to move first, right? I mean, in theory, at this juncture, looking at the data that we look at and just knowing there's a maturity wall over 24 and 25, the Fed could try to foam the runway and try to really create a soft landing, right? But that's why I call it a higher for longer paradox, because the longer you are high, you increase the odds of the recession, because all of these interest rate sensitive industries and parts of the markets are not going to be able to wait for that long. And so it's kind of like they should be cutting rates probably soon if they really want to create a soft landing, but they probably won't until they actually get proof that they need to cut. And so far, they don't have it.
I wonder if you think that they maybe made a mistake in constantly hammering the higher for longer argument, because it doesn't really give them much wiggle room. Listen, they're going to do what they want to do, but it doesn't exactly help their credibility if suddenly, let's say stocks were to collapse and then they cut rates like Greenspan did, right after the 87 crash. I mean, it seems like they've maybe overly committed in their rhetoric to higher for longer.
Yeah, no, it's interesting though. And I went back, we went back as a team and double checked the transcripts yesterday. Like Powell did not make reference for higher for longer yesterday throughout the Q&A. Meanwhile, earlier in the month at the New York Economics Club, he was much more hawkish and sounding like they're, going to stay higher for longer. So, I mean, I think that I don't want to say it's a pivot. I just feel like they're going to probably just keep rates where they are and not necessarily suggest it's higher for longer. They are where they are. This is the final resting point, most likely, 5.25 to 550. And then it's more about what makes them move in the opposite direction. So yes, I don't know, like you could always talk your way out of this, but I think the hurdle will be decently high. I don't think it's just going to be inflation and growth or just job losses. I think that you need that builds up over time, and that's what they kind of technically want to see anyhow to ensure that inflation is really put to bed. It probably requires markets as well as some sort of risks in the financial system to surface.
Seems to me that there's a pretty sizable disconnect between public markets and the private economy when you look at liquidity, sentiments, small business conditions, credit conditions. I mean, lay out for the audience some of the research that you've been doing as at least to small businesses. Take out the stock market side entirely. Let's go to the actual kind of more mom and pop type of entrepreneurs. How's the small business side been?
Yeah, I mean, that's a great point. And so I think what people sometimes fail to realize that the large corporations most likely will weather whatever sort of downturn we encounter next, whatever that may be, right? But it's really the small businesses and the access to working capital. And just we have to also realize that the starting points matter, that we came out of COVID with all these massive savings and a lot of government type assistance towards these smaller businesses that bought a lot of time, right? But now the question is, if you look at bank lending and how banks are much more risk averse right now, it's really showing through on all of these like NFIB surveys and really correlating well with credit availability. And so unless the banks start turning around and lending, which I don't see that happening, given their own issues that they're dealing with, then I think small to mid-sized companies are the ones that are going to really face the music of higher rates. As long as the Fed keeps them high, they're the ones that are going to be really taking the bigger hits. And as we know, most of the job creation, a lot of it is in the smaller business side. So I think that this is the starting point, and that you're going to see small businesses really pull back on activity, pull back on hiring, and eventually result in layoffs as well. And then we'll see what happens for the rest of the economy. But I think that's the first half of next year.
Well, that's the thing. It's like, all right, so if that's the first half of next year, you expect equities to respond off of that, starting around now, whether or not it does or doesn't, because seasonality, obviously we'll see. But if markets are a forward-looking mechanism, you'd expect that any concerns around that refinancing maturity wall that you mentioned, concerns around small businesses laying off, like you should start to see it in equity volatility, I would think, now.
Yeah, but I mean, like you and I both know that there was like the FOMO/hope premium in the marketplace that people don't believe that markets go down, right? So I think we need to see a more protracted decline in equities to really kind of break that sentiment, and then we'll at some point see a more final low. It's a more tradable low, or actually more investable low, to be honest. I mean, like I think last October was really a tradable low that got us through, and then of course the breakout from May up to 4,600 or so on the S&P. But I mean, what we're seeing, like where we are now, I mean, I think we're at a super critical point, which is why like I don't see like people saying, hey, rates going down, it's going to really help out equities. If they're going down, it's because something else is happening, more macro based, and like actually worse, means that things are getting worse, and the bond market's looking into the next year and saying, hey, we're not going to get the kind of growth that we saw this year. We were spared in many ways, right? We were spared because low rates in the beginning of the year, of the first half, allowed for a decent amount of housing activity. So in addition to the small business side, next year, housing is going to have a really tough start at the beginning of the year, which is the typical largest volume part of the season. It's spring housing activity, right? So at 8% rates, housing is not going to work next year to actually add to growth. Whereas this year it did. And then we got through the debt ceiling, government spending through the summer, which really amplified things. Like we kind of repeat that next year, I think it's a very low probability. So unless rates really do rally a lot here, and that's probably envisioning a macro downturn, it's hard to see how risk assets can actually stage a meaningful bounce. Now they can because everyone like believes in these seasonal things. But if we fail to really make break out of this downtrend that's really started in the last few weeks, then I think stocks are going to have to reflect the reality that we're probably heading into a slowdown next year.
Yeah, it is. I'm not a huge believer in the tech analysis, what I call the squigglies, but it's true. We're still technically in a down channel, right? For whatever it's worth on at least the S&P. I want to get your thoughts on the higher for longer dynamic as it relates to currencies. Because I think it seems clear that the ECB is not going to do the same higher for longer type of path. All right, Lagarde is probably more likely to lower rates than not much sooner than Powell. How does the currency side play into this? Because if the dollar were to keep strengthening against the euro because of just interest rate differentials, that's going to be still tightening without the Fed needing to tighten.
Yeah, no, I mean the long-term rates are going to at some point stall out here, but even the front end can only rally so much until the Fed cuts. So even we're only going to get so much additional kind of financial conditions benefits from that. And let's see, again, I don't want to make too much of the last 24 hours. We do have auctions next week and we have a lot of supply ahead of us. And this whole liquidity issue that I'm still concerned about going into year end. But then on the dollar side, yeah, I mean, the Fed could probably hold out the longest until something more materially happens in the US, whereas it's going to be challenging for the rest of the world. So this is when you get into this kind of dollar strength vortex. But I mean, the dollar is still super critical in the plumbing of the world, as we know. And any further moves from here, because the view, everyone starts to get into this logical framework. Well, look, rates are not going to go up any higher in the US or they might go lower. Dollars should go weaker. If the macro is getting weaker in the US and globally, it's been weak already, then the dollar probably stays strong, if not strengthens, because others are going to have to ease first before the Fed does. So I do think that the dollar move probably is not over yet, and usually it has a kind of last laugh and a big final move higher, which then is the tightening, which the Fed cannot control. And then they have to react to that as well. So those forms of tightening are still with us, and I don't think they go away. And yeah, so this is, again, goes back to the whole waiting game. What has to finally get their attention to have them change direction?
Has there ever been a start of a recession where the dollar is, as from a starting point, as strong as it has been? I mean, I can't recall of any time historically where that's been the case. I might be wrong.
At some point, you would think the dollar will pick up on that. But this is, I think we're reacting more towards the mechanical and the liquidity aspect of the dollar. Let's not forget the Fed is doing QT. The banking system itself is now not growing like before, so there's actually less there. And if you look at overseas dollar availability, that's also been declining. So I think this one is unique considering the massive increase of liquidity that happened right after COVID. And now that we're in the draining process, you could still have, I most likely think it actually amplifies the recession. In the past, when things were much more simpler, you would see either economic data getting weaker, you would believe it, number one. And then as it started to kind of come to fruition and broaden out in the economy, then you go into the pure fundamental framework of, the US is weakening, therefore dollars gets weaker. I think this time is different because of the structural features and how the setup was coming out of COVID with all this liquidity. So I think that the dollar probably won't just roll over that quickly.
So I think, it's been well documented, the inversion of the yield curve, the streak of that inversion, and now the steepening. And, again, most recessions tend to happen, shortly thereafter the steepening really does begin. Is there any chance that we can avoid a recession? I mean, there's no signal that's perfect, but the steepening part of this, I think, is a little bit ominous.
No, I think there's been a number of studies, and once the steepening turns, it's hard to avoid the recession. Now, listen, because the inversion was so deep, it's like this, and I know, and those that are listening, the bear steepening, which is when long-term rates rise faster than short-term rates, that's kind of rare. Now, that you can say, well, we live in a very unique situation, a different world than before. a world of heavy supply in a world where overseas rates are increasing after years of being super depressed at either zero or negative rates, that perhaps the paradigm is shifting enough where long-term rates can disinvert the curve. Now, completely steepening it, I'm not there yet. I think you would need to have an even bigger fiscal problem on our hands. And again, if that were to happen, I'm not sure how that's positive for risk assets anyhow. So I think that you can still go back to the idea of once the curve moves out, this inversion crosses over and starts to steepen, still probably a good recession signal. The only caveat being that we're coming after 15 years of low rates / QE to a world of heavy fiscal supply. That's probably explaining a portion of it, but I don't think it's enough. But from here on out, though, the curve would have to start steepening from short-term rates. And that's why it really comes down to the Fed.
Yeah, and that's something you often don't hear too much about, that further steepening has to really come more from the short end, just because there's been so much damage already on the long end.
Sure.
I got to tell you, I also don't buy the argument that it's like, yields are going to keep skyrocketing further and further on the long end. I mean, housing's already largely, you can argue, at a standstill. And I think people forget that technology still means that the economy is largely more efficient than it was in the 80s, right?
Yes.
So technology is economics 101, right? There are shifts in the yield curve, right? And it's not more than just sort of the yield curve itself moving, in terms of long and short end. The entire shift happens, which is the bear steepening or bull steepening. So, and technology is a driver of that. So that hasn't changed. That should still shift anyway, the yield curve, you would think, more left.
Yes. So we're now at that inflection point, and that would argue for rate cuts in the first half of next year, right? And in my forecast, have that. I mean, I have it with a little bit of like the possibility of it getting pushed back, but we do have the term bank funding program that comes due in March that most likely gets extended. But during that time period into Q2 next year, the Fed can start cutting rates. That would be assuming they don't hike again, which we don't think they will. July was the last hike. That's 9 to 10 months into the future. The Fed's cut rates in the past like that. They don't wait 12, 15 months. They don't have to wait 12, 15 months. So in between that time period, given what's going on with the banks, I think that the curve has to start steepening here. That's really the real savior for the banking system. It's going to it needs a steeper curve.
But that wouldn't be a savior necessarily to housing, right? Because the housing will still be based on the 10-year.
That's right. I mean, 10s will lag that move, but and I think that would probably, the window be lost by then anyway. It really will come down to, can mortgage spreads tighten that fast enough in the beginning of the year? But still, I think that the damage is done for housing at this point, because the Fed, again, they're not going to react to cutting until they see proof of either really big job losses and inflation collapsing, which could happen in like 6 months. I think that's a higher probability than most people think. But they're going to wait to see it. They're not going to just jump to it and start cutting proactively. And so while you're waiting, it's going to be at the most inopportune time for housing, because rates are just going to stay elevated.
Everybody, please make sure you follow George here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be podcasts under Lead Lag Live. So you mentioned with MEFG, Japan-based company, and I keep on hitting on Japan as, I think myself, I could be totally wrong, being in a crisis given the yen, and every time it seems like the BOJ has the bond market under control, there's another unscheduled bond buying program that takes place. Relate what's going on with Japan to the U.S. and Federal Reserve policy, because I keep going back to, if there's going to be some kind of crisis that sends risk assets lower, it probably has to be something coming from a part of the world that the Fed can't necessarily preempt. Maybe I'm wrong on that, but I want to hear your thoughts on what's going on with Japan and its monetary policy.
I mean, look, I'm partial to that concern as well, but not necessarily from the Japan lens, but in general, the whole dollar strength. And let's remember, we have the highest rates in the world for U.S., and a lot of companies and countries around the world are impacted by this higher U.S. rate environment. So I do think that there is a risk that we might get surprised by some sort of unknown out there. It's going to come from a foreign market, not necessarily the U.S., as the first kind of salvo in this risk off that I think will build up over the course of next year. Japan specifically, though, I mean, they're unwinding policy, right? And after many years, right? And so there's a kind of give and take between what's happening in the U.S. versus Japan on many different fronts. The biggest ones are the Fed was the first mover and really aggressive and hiked rates a lot. And that really created that big interest rate differential. It's had a big impact on the currency. So, it would really help if US rates went down. That would, give a helping hand to the BOJ in many ways, right? If rates in the US decline and they don't, Japan doesn't have to really adjust rates as much, that would help out, relieve some pressure on the currency. So there's kind of this give and take going back and forth. I don't think that's what's driving policy per se, but nothing operates in a vacuum, and currencies are pairs, right? They're relative to each other. So I do think that the Fed stay on hold for longer makes the BOJ's job harder. And if the Fed were to kind of be forced to cut sooner, that would kind of relieve some pressure. I think that's my own personal view. And what BOJ's been doing up until this point is like gradually just unwinding all this ultra accommodative policy. Our view is at some point they're going to have to, and at that point it's approaching very quickly, that they're going to have to completely do away with YCC. But then I kind of think really like 2 or 3 steps down the line, and this is just me just thinking off the cuff here, that it would be ironic that one day the US might have to do YCC and Japan is removing YCC. But that's a whole topic for a whole other day. But I do think that the window for them to navigate could potentially get wider if the Fed stays on hold, or close if the Fed starts cutting. How do they do it? So I think this, being the last mover of removing policy, makes it so tricky for how Japan, handles their rate policy and currency policy.
That would blow a lot of people's minds if the U.S. did yield curve control and Japan gets rid of it. But like we often talk about central bank credibility, and I get it. BOJ owns the entire bond market, right, and it also owns ETFs that have exposure to Japan's stock market. What would the implications be of credibility of the BOJ being threatened? Because let's face it, they have never really had to deal with a situation like this.
Yeah, look, I think it's not just the local issues; it's also bigger from the potential macro issues, which is why you have to slow walk this thing about just leverage in the system and access to cheap liquidity over the years. The idea of the yen carry trade and how that helped out a lot of emerging markets. So this is a very big one. So you have to really think through like how it could unravel. And BOJ, of course, really focused on their own local domestic needs and wants. So I think it's, has global implications from just the Japan angle, but then when you couple it with the US, not to mention on the US side, Japan being a very large buyer of US fixed income. So like all these things are intertwined. It's a very delicate dance. And I think, which is another reason why, like there's, at some point, we can't keep US rates curves inverted forever and rates this high, because we also need foreign investors to come back in and help us with all of this debt load.
Well, that's the thing that's interesting to me. It's so you've probably seen a lot of those charts as well. You look at the percentage of holdings that China has of treasuries and Japan, and it's been in this kind of steady decline. It's like, all right, well, at some point that yield does become pretty attractive. I understand they still have to do something on the currency side, but I look at all those charts and say to myself, okay, we're probably at a juncture now where the foreign buyers actually, start kicking up purchases. They actually, that those trends reverse.
Yeah, but even there, it's the same thing like with the regional bank story. You need a steeper curve to make the carry work better. And this it's like if you look at these percentage of outstanding holdings of U.S. versus the rest of the world, there was a real clear shift, really after Basel III and all the banks, being required to hold treasuries, and look at what that did. And now post COVID, I call it the domestication of the U.S. bond market. People don't like to believe it, but that's exactly what happened with the Japan bond market in the late 1990s, early 2000s. When rates were attractive enough and your equities aren't going anywhere, guess what? You buy fixed income. So I think that the U.S. bond market's always going to get funded, right? I have no issues with that. And especially if rates stay elevated and the curve eventually re-steepens, I think, investors are going to realize that you're going to have to come back to fixed income, because you're going to look up one day and say, I could have bought at 5%. They're now back at 3%. I think that's going to start to come back into the bond market. Like this fear of it's going to go to 7 is the wrong way of looking at it. You should think about like you immunize and start to really build some decent cash flows and the risk-free rate, plus not to mention really high quality corporates, munis. This could be a gift. We'll see.
Yeah, I know. I think it's a reminder that the U.S. government can't default. Right? It's obviously the higher yield, but Yeah, I keep emphasizing I myself am bond bearish, but for different reasons. I'm bond bearish because of credit risk, right? I'm kind of corporate credit bond bearish.
Yes.
Just because if we are heading for a recession, right? You should see, by the way, you should see, I mean, you're starting to see a little bit at the margin, but you should see credit spreads really widen. And usually when it widens, it happens very aggressively, which is why I keep saying slowly, then all of a sudden. It's been a while since, I think investor traders have been reminded that the reason why U.S. government debt is considered the pristine asset is because they've got the money printer and you're going to get a return of capital.
Yes. It's always the willingness to pay, right? Or the ability, right? And so, and I think the two sometimes blend, and with corporates, they don't have that, right? I mean, some people could argue, really high quality corporates have a version of a printing press through good governance as well as products that they offer and services. But at the end of the day, the currency is still under the government's guise. And so I completely agree with that. I mean, you mentioned like the whole sudden versus stop. I mean, it reminded me of the other thing that, which is related to our current economic backdrop, which is like the U.S. consumer, which like they shop until they drop. And I'm kind of concerned about the upcoming, holiday shopping season, and then what that means for 2024 and everyone having to pay their bills for the first time at like 20+% interest on consumer credit. So I am kind of concerned with like all this stuff is like coming to a head where we're all running really fast, and then there's like a sudden stop, almost like an emerging market when they lose capital. When they lose like capital to liquidity, emerging markets have like this gap risk. I'm wondering if the consumer has the same issue. It's tied back to the small businesses. It's tied back to corporates, that you're going to have this big widening of spreads consumers can't afford, and then you just have a typical recession, and that really puts retail in a really tough spot.
Yeah, and I keep going back to, you look at the retailer stocks, XRT as a proxy. I mean, all that agrees with you. They have not been in a new bull market whatsoever. So there's an interesting disconnect between the narrative of a strong consumer demand pull inflation and the stocks which are supposed to be benefiting from that.
Yeah, 100%. Even we talked about housing. The housing ETFs rolled a little bit, right? Bank stocks aren't doing great. It's other than, the select Magnificent Seven, right? Like the stock market doesn't act like as if it's a new bull market or in line with a really robust, sustainable, organically growing economy. We pump in a lot of liquidity. Yeah, you can kind of have these spurts, but really a sustainable recovery. I mean, my view in general has been that we elongated the 2019 or the 2019 economic cycle. Once we got through the forced shutdowns and COVID, we elongated that business cycle. We never really took care of the malinvestments. And now with these high rates, those malinvestments, like you mentioned the zombies at the beginning, I think the zombies are going to have a hard time next year.
Has there been anything surprising to you when it comes to the bond market in terms of how you thought things would play out at the start of the year versus where things are now?
Start versus the middle of the year, different in the sense that we were more pessimistic at the beginning of the year, but then once we saw the debt ceiling resolution, the amount of debt that they had to do, we quickly retooled and got more into the kind of the bear steepening view. I think what's really surprised me has been the credit market and the ability for it to actually tighten in this world, right? So we've seen credit spreads actually narrow. That's really the one major call that we got wrong this year. The spreads tightened more than we had thought. We thought they would be on a widening, anticipating the macro that we just went through. So it's been really credit that surprised me the most.
Yeah, I mean, it's been one of the most incredible disconnects. I do wonder, because I think you can correct me wrong on this, but I think a lot of the kind of triple C junk issuances also are tied to commodity plays. So to the extent that commodities have been strong, you could maybe argue that's part of the reason. There's also the argument that there's just not that much junk debt out there. That's not really true because more and more things have been rated lower quality in the bond market broadly, right, over the last several years. So I do wonder if that still remains sort of the real big canary in the coal mine, so to speak.
Yeah, no, I mean, I think the composition of what's coming to market, that's definitely true. And, and this shift more towards leverage loans and to other forms of financing could also be what's, buying more time. But at the end of the day, if you're the whole definition of the zombie and not being able to pay for interest expense from earnings, that matters. Because again, this is why the Fed waiting game is so critical. Like who's going to move first? If we're going to see your cash flows get eaten up by all your interest expense, at some point you stop expanding your business and then you have to start laying off people, right? And I think that's the part of the cycle that people don't want to believe is coming, but I think it is.
What's the optimistic side, right? So again, we're all assuming recession. Yeah, I think probability's favored. Okay, oldest, but what's the optimistic side? I mean, aside from the idea of, Powell was able to kind of thread the needle, what could happen either from an exogenous perspective or internally that, just makes the economy, rip back and have GDP more be about growth and private sector activity than inflation and public sector?
No, look, you have to play the other side. I agree with you. And I've been trying to challenge our house views around what if we're wrong and what would that take, completely wrong on the macro medium term outlook. And that, I think, really, the Fed, again, would need to start to pivot here. And I don't think what we saw yesterday is a pivot. It's more about them drawing the line in the sand that they're going to be on hold for as long as they can. So they would have to get proactive. I don't see that happening yet. A much more coordinated effort out of China. And that's a big maybe. China is a whole other topic we could spend a whole hour on. So, and what happens there? There was so much hope at the beginning of the year of the China reopening. And of course, it didn't work out that way. So, if China is able to somehow get its act together on easing and restructuring real estate and its, the banking system over there, that's a big one. So it's a big maybe. It would have to be China, and it would have to be something so structural. And of course, some sort of peaceful resolution to all these ongoing wars, which is a whole other topic. So a lot of those things just to me seem really unrealistic at this point in time, or will they come soon enough? Eventually, hopefully they do happen. I just don't think they're going to happen fast enough to catch us from dipping. So yeah, I think, it's going to be hard to see that happen. And I guess people say, well, George, fiscal is going to keep spending like there's no tomorrow. I was like, okay, but there's a concept called rate of change, and the idea that you have to outdo what you did the prior year. I just can't see how they're going to be able to beat this year spending in an election year where I think the Republicans will probably try to hold back spending throughout 2024. So I don't think that we accelerate in spending next year. So it's going to be hard to beat the comps of 23, maybe China. And just organically at 5% plus rates, you don't accelerate the economy from this level of rates. Maybe at 2 or 3%, maybe we can get an upturn. But this is how you stifle the economy and take away the oxygen and you slow it down. These rates are just too high. The curve is too inverted. It's just a matter of time.
I also think, I put out that post a couple of days ago. I think it's also much more nuanced, this idea of, we're going to have persistent inflation because of government spending constantly rising. Look at the debt GDP, the debt clock, right? The USA debt clock. And it's I go back to, okay, government spending is only inflationary if it gets sent out to a whole bunch of people to increase the velocity of money, which is largely what happened with COVID. Whereas, if spending keeps on rising, but it's only being funneled to a select number of economic actors, that money gets stuck. So it widens the wealth gap, but that's not necessarily inflationary. So I think there's nuances even in that way of thinking about things. What else do you think is being missed in terms of the current narrative around rates, the bond market, duration credit? I suspect it's a lot of, I think, what we've seen this year when it comes to the bond market is very similar to what you see with stocks, which is narratives following price, right? So you've got a popular narrative around duration and it keeps on selling off. What are some of the things which, if you're going to write the story of next year that nobody's thinking about, would be sort of the next narrative to track? I
mean, look, I think it's going to come down to the access to credit and the ability for deals to get done while we're waiting for the Fed's next move. So I'm not really seeing anything super glaring other than the whole concept of the waiting game, which we've been discussing. There's no real structural issues as bad as in 2008 that at least I can, scan and look on my radar. And so I think it's just really it's years and years of low rates relative to a fast hiking cycle, relative to that, rates still matter. This idea that rates don't matter, I think, was a big narrative this year too. That was why people were gung-ho on risk assets. But at the same time, there were super bearish durations. I think that flips and we go back to more reality that the disinflationary forces are still out there. They're just kind of waiting. We have the supply chain disruptions. We have a lot of things that have happened. And of course, you could say those are going to probably persist, but will they persist at the same magnitude? Probably not. And hopefully we'll get through some of these more darker days. And then we'll look up and realize that the economy hasn't that structurally changed and we can't afford to live at high rates. So I think it's just getting back into calibration next year will require the Fed to finally relent. So yeah, I'm not seeing anything other than that.
Anything on the commodity side that's interesting? I only mention that because cost push inflation was a narrative all throughout last year. And a lot of that has largely come back in, at least in terms of the industrial metals.
Yeah, well, the thing that at least kind of I started kind of looking at is just outside of the industrials, but actually even just precious metals and like how gold's been behaving. Like gold is sensing something's up. So I think gold.
Say that louder, George, because I put that post out. I said it's more than just an investment; it's a warning.
Yeah, that's a great point. Yeah, I mean, gold is probably better at reading the macro conditions now than the long bond has been, which usually in the past, duration would win, and it had a much greater discounting factor of like what reality is. I think that the way gold is traded in the last couple of weeks, breaking that downtrend, spiking higher, realizing that at some point we're going to need to go back to the printing press, perhaps. I mean, I think there's some of that is what gold is picking up on. And the printing press meaning just you have to cut rates. I'm not sure the Fed's going to go to QE right away, but I think they're going to try to avoid that for sure. But I think that gold is picking up on like this is the only way you can get out of this is you're going to need to add more liquidity to the system. So I think that's what the gold market is probably picking up on. This is talk is tough on high rates forever, but at some point they're going to have to cut. So I think the gold market's picking up on that as well.
Yeah, it's funny. It's actually amazing to me that people forget that the government needs negative real rates, right? I mean, which gold is supposed to do well under. So maybe that's sort of the real message. So which goes back to, you can have higher for longer, but if you keep rates higher for longer, but you just get rid of that positive real rate and go back to negative, that's still actually a sizable move for duration treasuries.
Exactly. So yeah, I think that on the rest of the commodities complex, like I'm also impressed that we have obviously these tragic wars going on at the same time, and oil's not catching a bigger bid, right? Like shouldn't that be inflationary? Like, but it's not. So like we're not seeing like the amount of mileage that Americans are driving, just in general, the usage of energy is declining. I feel like something's up there too. So I think that the energy commodity sector is picking up on that, unless we have a huge escalation in the Middle East, that, like globally, it's hard to keep oil prices high.
So on a more fun note, so you put that post up, you were just walking in Japan and randomly met up with Alonso. You just saw each other. It's like, oh, I know you from X.
Yeah, well, Alonso has known me for many years and many clients and investors. He was a long-term bond investor for many years. So he's seen me a few times in person, and he's the one that reached out to me. He looked up and said, I think I saw you in Japan. I was like, are you in Japan? I was like, well, dude, I work for a Japanese bank. Like, how many guys do you think will be like looking like me here? So he was like, we were just joking around, and he reached out and we caught up, and it was really nice to see him in person. He's a great guy. He's a hard worker and a good macro thinker.
Yeah, I'm a fan of the way he framed things. George, for those who want to track more of your thoughts and work and research, where can you point them to?
Yeah, look, if you're an institutional investor and you have relationships with MUFG, of course, hopefully you should be getting our content. So definitely reach out to my email. But just for the broader public consumption, to the extent that I'm able to kind of stay active on Twitter, I do so. We do post our more thoughtful pieces up on X, as well as I will have my own opinions from time to time on X. So always happy to engage if there's anything going on, and happy to connect with you once again, and keep up the good fight. I think you're doing amazing work. So I think you're onto something, Mike, and I think it's early days.
Yeah, I appreciate it. I always go back to I'm wrong a lot and I'm right a lot, like everybody, because nobody can predict the future, right? But yeah, obviously I've been very wrong on equities this week, but not wrong on treasuries, right? So, but then the way team work, over time, that's sort of the point of this idea of trying to identify conditions. Everybody, please make sure you follow George here on X. I'll have this as a podcast in a couple of days. Hopefully I will see you all tomorrow. Thank you, George. Appreciate it.
Thanks, Mike. Appreciate it.